Gearing up for a very decisive week on Wall Street, as yesterday I checked at the close, the S&P closed at 2775. That is very close to the resistance level of 2800, which is held since last October. Now, the fall in October was a result of rising interest rates, which, of course, when interest rates rise, the value of assets falls. That's because many assets are interest rate sensitive. This is certainly true of stocks, because corporations need to take out credit to borrow money so that they can operate their business. If credit gets more expensive, then they can do less business. They're going to make less money, and the value of their stock is going to fall. So now that we're coming at and hitting this resistance level of 2,800, you have to ask yourself, well, is the stock market now in a better position fundamentally than it was in October, or is it in a worse position, or is it about the same? I think it's pretty clear that it's in a worse position all around. If you look at since then, we've had an additional rate hike, and now the Fed has claimed that they're going to pause rate hikes after this, so no more rate hikes. I guess we're just going to peak at 225 basis points, something ridiculously low. However, quantitative tightening, the Fed's balance sheet runoff, has continued unabated, and that really is, I think, a bigger issue, because you're dumping an absurd amount of bonds, U.S. Treasuries, into the bond pits that have to clear the market, and that's going to push rates up, all else equal. So even if you're not tightening the Fed funds rate, all those U.S. Treasuries are going to have to clear the market before people start taking on riskier debt like corporate bonds. So all these corporate bonds now have to compete with a lot more government debt. We're basically going to see a crowding out effect, which would be the first time since the 1980s that that's occurred. Not to mention the terrible retail sales numbers from the last quarter, and existing home sales, which fell something absurdly like 10% year over year. Now, with all that said, I don't think that we're going to suddenly break through the resistance at 2,800. I think we're going to probably, potentially, drop even further than we did down at the Christmas Eve lows. And that was, 17% for the S&P on Christmas Eve? That was down from the highs? So we could easily drop down 20 now, because, we're weaker than we were then. Not to mention that the economy overall, even if the stock market holds out, the economy is going to go into a recession probably sometime this year, but definitely next year before the election. There's no way that Trump gets through his first term without a recession, because we are in the middle of a tightening cycle. The Fed hasn't tightened much, but they've still tightened. And as some of you may know, once that process gets underway, there's no going back. People at that point people operate under the assumption of falling interest rates. That's how that's why asset prices keep going up, because interest rates have been falling consistently since 1987, when Greenspan took over, and then when they bottomed out at zero. Things were pretty good. People were comfortable. We didn't exactly have a massive boom, because it was still a very weak economy, but we were able to survive. But if you reverse that trend and interest rates start trending up, well, then everybody's going to lose money. People who are barely surviving are now no longer going to be able to pay the interest on their debts. They're going to have to tighten their belts. They're going to have to stop consuming so much, because they can't run up such a big credit card bill. They're already levered up. Because of all this cheap credit, people are so far in debt that even a small hike in interest rates is going to have a big effect on their financial stability. Frankly, I wouldn't be shocked if by the end of the year the Fed funds rate is back at 0% and we're in QE4. Because if you look at a chart of stocks from the last 10 years. There really wasn't that much. There really weren't much gains after the end of QE3. It was QE really that was propping up the stock market, which is why QT is having such a negative effect. Now the rally since Trump got elected was one because stocks tend to like Republican presidents because they're considered good for business, and then the really, really huge corporate tax cut that gave a pretty big a boost to stocks. But again, now that's over, and we've got QT. You're gonna have you're not gonna have a growing stock market because under QT, because the stock market is based entirely on an asset bubble. I mean, you don't triple from the lows of 2009 and then call that, and consider that to be in touch with the fundamental value of these assets. This is purely a credit bubble. And it's a credit bubble so big that nobody can afford to let it pop, because if they let it pop, then we're all screwed. The only choice is more and more debt and, of course, more and more money printing. I predict that in 2020, whoever is the nominee, they will give a big opportunity to the modern monetary theorists, i.e. the Keynesians on steroids, to try and work their magic on our stagnant economy, which will probably be, like I say, will almost definitely be in a recession at that time. The MMT crowd will try and inject more debt than we've ever seen into the U.S. economy, and they won't just concentrate it in the stock market so that it keeps from inflating consumer prices. They're going to dump debt everywhere, and we're probably going to see the greatest inflation since the 70s, and it won't have the desired effect that they would like. I will be probably there in the mix of GDP growth and inflation. It'll probably lean more towards the inflation end. And of course, that will only force them to inject more and more money. Now, they may give up, but I mean, frankly, at this point, the people are so sycophantic, they'll probably continue until they break the dollar. So, again, hard to know that far off into the future, but I'm not too optimistic about how things are going to go in the next few years. I really think that I won't see a market like this again in my lifetime. I doubt that I'll have the chance to get in on a consistently upward trending stock market that lasts for 10 years and is triples in value from the lows, because all of this has been built on debt since the 80s. We don't really have a real stock market anymore. And despite what the modern monetary theorists tell us, there is a limit to how much debt one can incur. We do still live in a world of scarcity in which production precedes consumption, and we cannot consume more than is produced in the world. I will make a follow-up video about this next week, detailing the reasons why either I was right or I was wrong about what's going to happen with the S&P this week. So please stay tuned for that, and consider subscribing, and definitely like this video if you've made it this far, and I would appreciate your commentary below. I'm certainly not the most intelligent financial analyst in the world, but I do have an opinion or two. So please share yours as well.